What if someone took $28 billion and used it to prove a mathematical theory? That's exactly what happened. James Simons, mathematician and founder of Renaissance Technologies, spent 3 decades testing whether markets could be understood through probability rather than intuition. The results were staggering. 39% average annual returns from 1988 through 2018, according to data compiled by institutional research firm Institutional Investors Alpha. But here's what makes this fascinating from an educational standpoint. Simons wasn't trying to get rich. He was testing a hypothesis. The wealth was a byproduct of proving that mathematical models could identify patterns in market behavior that human intuition consistently misses. I'm going to take you through the evolution of this mathematical framework, not because I'm promising it will make you wealthy, but because understanding how probability works in financial systems might fundamentally change how you think about money. This is about intellectual frameworks, not get-rich-quick schemes. Let me start with a concept so simple it sounds absurd. Most financial decisions are probability calculations that people mistake for certainty predictions. Think about that distinction. When you decide where to invest, you're not predicting what will happen. You're calculating which probability distribution offers the most favorable mathematical expectation over extended time periods. According to research published by Vanguard spanning market data from 1926 through 2023, approximately 94% of portfolio variance over 10-year periods can be attributed to asset allocation decisions rather than individual security selection. That's a statistical statement about probability distributions, not a prediction about your specific outcome. Simons understood something that most people miss. The question isn't whether markets are predictable. The question is whether probability distributions are stable enough over sufficient time horizons to create positive mathematical expectation despite inherent uncertainty. Let me demonstrate what I mean with a thought experiment. Imagine you have 2 investment approaches. Approach A tries to predict which specific stocks will outperform next year. Approach B ignores predictions entirely and focuses on identifying probability distributions that favor positive outcomes over 20-year periods when you maintain systematic behavior regardless of short-term results. Which approach do you think has higher mathematical expectation? If you said approach B, you're thinking like Simons. If you said approach A, you're thinking like approximately 90% of individual investors, according to behavioral finance research from Morningstar, analyzing account data from 2 million households between 2000 and 2020. Here's the transformative concept. Financial success isn't about being right about the future. It's about structuring probability in your favor and having sufficient discipline to let mathematical expectation work over time horizons that make statistical sense. This is where it gets counterintuitive, and frankly, this is my favorite part to teach. Simons discovered that the more certain someone feels about financial predictions, the more likely they are to sabotage their own mathematical expectation. This isn't opinion. This is documented behavior. Research from the National Bureau of Economic Research, examining trading data from 1.4 million accounts at a major discount brokerage between 1991 and 1996, found that investors who traded most frequently, presumably because they felt most certain about their predictions, underperformed the market by approximately 6.5 percentage points annually. The investors who did essentially nothing outperformed those who did a lot. Let me show you the mathematics of why certainty feelings destroy outcomes. Suppose you invest $10,000 with 2 different mental frameworks. Framework 1 is certainty seeking. You invest $10,000, but every time the market declines 15%, you sell because you're certain things will get worse. Every time it rises 15%, you buy more because you're certain momentum will continue. According to historical market behavior from Federal Reserve economic data spanning 1928 through 2023, This behavior typically locks in losses during declines and chases performance during peaks. Framework 2 is probability acceptance. You invest the same $10,000 with the understanding that you have no idea what will happen in any given year. But you know that according to data compiled by dimensional fund advisors analyzing U.S. stock market returns from 1926 through 2023, positive years occurred approximately 73% of the time, and the average annual return over rolling 20-year periods was approximately 10%, despite frequent drawdowns. Let's calculate what happens over 20 years. Framework 1, due to behavioral interference triggered by certainty feelings, might average around 4% annually after you account for mistimed entries and exits. $10,000 becomes approximately $21,900. Framework 2, which simply accepts probability and maintains systematic behavior, might capture approximately 9% of market returns. $10,000 becomes approximately $56,000. That's a $34,100 difference, created entirely by the psychological need for certainty versus mathematical acceptance of probability. Simons recognized this pattern in his own research. According to interviews documented in the book The Man Who Solved the Market by Gregory Zuckerman, Simons would often say that his models weren't predicting anything. They were identifying probability distributions and maintaining systematic behavior regardless of how uncertain any individual outcome felt. Here's the insight that transforms thinking. Uncertainty isn't your enemy in financial systems. Certainty feelings are your enemy because they trigger behavioral interference that disrupts mathematical expectation. When you feel certain, you act. When you act based on feelings rather than probability distributions, you typically make decisions at precisely the wrong times because feelings spike during emotional extremes. Fear feels most certain at market bottoms. Greed feels most certain at market peaks. Both feelings are statistically horrible timing signals according to 50 years of behavioral finance research. The mathematical framework that Simons developed wasn't about eliminating uncertainty. It was about eliminating the behavioral interference that certainty feelings create. His models traded thousands of times daily, but the models never felt certain. They calculated probability and executed systematically. For individuals who aren't running quantitative hedge funds, the application is simpler but mathematically similar. Stop trying to feel certain about financial outcomes. Start calculating probability distributions and maintaining behavior that aligns with favorable mathematics over time horizons where probability has room to work. Now, watch how this concept evolves when you add time as a variable. This is where the mathematics becomes genuinely beautiful. Simons didn't start with financial markets. He started with pure mathematics, specifically geometric topology and pattern recognition. According to biographical information from the Mathematics Genealogy Project, Simons earned his PhD from Berkeley in 1961, studying minimal varieties in Riemannian geometry. He was solving abstract mathematical problems that had nothing to do with money. But here's what's fascinating. The same mathematical frameworks that identify patterns in geometric spaces can identify patterns in probability distributions across time. It's the same underlying mathematics, just applied to different data structures. Let me show you how this evolution happened and why it matters for understanding financial behavior. In the early 1980s, according to analysis documented in academic research from MIT's Laboratory for Financial Engineering, Simons began exploring whether statistical patterns that worked in geometric proofs could identify non-random patterns in market price sequences. The hypothesis was elegant. If markets were purely random, like coin flips, then no pattern should persist. But if markets contained any non-random elements driven by consistent human behavioral biases, those biases should create statistical patterns that repeat across sufficient data samples. Testing this required massive computational power and enormous data sets. According to company disclosures compiled by institutional research firm Prekin, Renaissance Technologies analyzed decades of price data across thousands of securities, looking for patterns that persisted over statistically significant time periods. Here's what they discovered, and this is crucial for understanding how probability works differently than prediction. Short-term price movements are approximately 85 to 90% random, according to statistical autocorrelation analysis. But the remaining 10 to 15% contains patterns created by consistent human behaviors like momentum chasing, panic selling, overreaction to news, and dozens of other cognitive biases. 10 to 15% doesn't sound like much, but mathematics works like compound interest. Small edges, compounded over thousands of decisions across extended time periods, create enormous outcome differences. Let me demonstrate with numbers. Suppose you're making investment decisions with 51% probability of being correct versus 49%, a tiny 2% edge. Over 100 decisions, randomness dominates, and you might be right anywhere from 45 to 55 times. But over 10,000 decisions, that 2% edge becomes statistically significant. The law of large numbers takes over. Simons built systems that made thousands of trades daily, each with tiny probability edges. According to estimates from quantitative finance researchers, the average edge on any single Renaissance trade might be 1% or less. But across millions of trades over 30 years, those microscopic edges compound into the 39% average annual returns mentioned earlier. Now, here's the evolution that matters for regular investors. You can't make millions of trades, but you can make decisions that align with probability distributions that favor positive outcomes over extended periods. And you can maintain those decisions systematically despite feeling uncertain. According to research from Vanguard analyzing investor returns versus fund returns between 2000 and 2020, the average investor underperformed the very funds they were invested in by approximately 1.7 percentage points annually. The fund did fine. The investor's behavior inside the fund sabotaged the outcome through mistimed trades, driven by certainty feelings about short-term predictions. That gap represents behavioral interference, disrupting mathematical expectation. The fund was giving them favorable probability. Their behavior was destroying it through mistimed trades driven by certainty feelings about short-term predictions. The evolution from prediction to probability isn't just academic. It's the difference between $10,000 becoming $28,000 versus $56,000 over 20 years, using the conservative estimates I mentioned earlier. Before we continue deeper into this mathematical framework, quick question. Are you the type of person who makes financial decisions based on data or based on feelings? If you said data, subscribe to this channel right now, because everything I share is backed by research from institutions like the Federal Reserve, Bureau of Labor Statistics, Vanguard Research, and peer-reviewed academic journals. I cite sources for every statistical claim. If you value evidence-based thinking about money, you're in the right place. Hit subscribe. Here's an insight that surprised me when I analyzed Simons' methodology. Complexity in the model, simplicity in the behavior. Most people think Renaissance Technologies' success came from having the most complex algorithms. That's partially true, but it misses the deeper principle. According to interviews with Renaissance researchers documented in quantitative finance literature, the firm's models were extraordinarily complex, analyzing thousands of variables across multiple time frequencies simultaneously. But the behavioral framework was absurdly simple. When the model said, "Trade," you trade. No discretion, no second guessing. No certainty feelings interfering with probability execution. This reveals something profound about financial decision-making that applies whether you're running a quantitative hedge fund or managing a retirement account. The mathematics can handle complexity. Human behavior cannot. Let me demonstrate why simplicity in behavior matters more than complexity in analysis. According to research from Morningstar analyzing mutual fund performance data from 1990 through 2020, actively managed funds as a category underperformed their benchmark indices by approximately 1 to 2 percentage points annually after fees. But here's the critical detail. The underperformance wasn't evenly distributed. Some active managers, particularly those with systematic approaches and disciplined processes, matched or exceeded index returns. The destruction came from behavioral inconsistency. When managers abandoned their stated methodologies during periods of underperformance, outcomes deteriorated. When managers maintained systematic behavior despite feeling uncertain about short-term results, outcomes improved. The variable wasn't analytical complexity. It was behavioral consistency. Simons eliminated this variable entirely by removing human discretion from execution. His researchers built complex models, but once built, the models executed with mechanical simplicity. No feelings, no predictions, no interference. For individual investors, the application is direct. You can't eliminate feelings entirely unless you're a computer. But you can structure behavior to minimize their interference with mathematical expectation. Here's a calculation that demonstrates the cost of behavioral complexity. Suppose you invest $500 monthly for 30 years. Simple approach. You invest the same amount every month regardless of what markets are doing, what news says, how you feel. You're capturing approximately 9% average annual return based on historical U.S. stock market data from Federal Reserve Economic Research. 500 monthly at 9% for 30 years equals approximately $907,000. Now suppose you add behavioral complexity. Sometimes you invest $600 when you feel confident. Sometimes you skip months when you feel uncertain. Sometimes you switch to different investments when you read something compelling. According to behavioral finance research from Dalbar analyzing investor returns versus market returns, this behavioral complexity typically reduces returns by approximately 2 to 4 percentage points annually. Same $500 monthly average, but now you're capturing approximately 6% annually due to behavioral interference. Result? Approximately $503,000 after 30 years. The complexity cost you approximately $404,000. That's the price of letting feelings interfere with mathematics. Simons understood that the greatest threat to mathematical expectation isn't market randomness. It's behavioral inconsistency. Markets are uncertain, but probability distributions are stable. Behavior, driven by certainty feelings during emotional extremes, is the unstable variable that destroys outcomes. The insight here transforms how you structure financial decisions. Don't try to build complex analytical frameworks you can't maintain behaviorally. Build simple frameworks you can execute systematically regardless of how uncertain you feel. According to research from Dimensional Fund Advisors comparing simple index strategies with complex tactical approaches over 20-year periods, the simple strategies outperformed complex strategies approximately 67% of the time. Why? Because simple strategies are behaviorally sustainable during periods of doubt. When your strategy is simple, you can maintain it when you feel uncertain. When your strategy is complex, you abandon it the moment short-term results disappoint because complexity gives you too many decision points where feelings can interfere. Simons' models were complex, but his behavioral framework was bulletproof simple. Execute what the model says. For regular investors, the translation is equally simple. Determine probability distributions that favor positive outcomes over your relevant time horizon, structure systematic behavior that aligns with those probabilities, and maintain that behavior regardless of short-term uncertainty. Now we reach the transformation point where understanding shifts from intellectual to operational. This is where theory becomes framework. Simons faced a challenge that every investor faces. How do you maintain systematic behavior when short-term results scream that you're wrong? According to data from Renaissance Technologies' Medallion Fund Performance, compiled by institutional research sources, even with 39% average annual returns, the fund experienced numerous drawdown periods where it underperformed for weeks or months. During these periods, the mathematics hadn't changed. The probability distributions hadn't changed. But the emotional experience of watching money decline creates powerful feelings that you should do something different. This is the transformation challenge, converting intellectual understanding of probability into behavioral execution during periods of emotional stress. It's one thing to understand mathematics when things are going well. It's entirely different to trust mathematics when your account balance is declining. Let me show you the mathematics of drawdowns and why understanding them transforms behavior. According to Vanguard Research analyzing U.S. stock market data from 1926 through 2023, the market experienced negative returns in approximately 27% of calendar years. But within those losing years, the average decline was approximately 12%. If you invested $10,000 and experienced a 12% decline, you're now at $8,800. Here's the transformation question. Is this a catastrophe requiring action? Or is this a predictable probability event requiring patience? Mathematics says it's the latter. Feelings say it's the former. The transformation happens when you structure behavior based on mathematics despite feelings. Let's calculate what happens with two approaches to this same 12% decline. Approach 1 is reaction. You feel certain this decline will continue, so you sell to preserve capital. You wait 6 months until you feel certain things are better, then reinvest. According to Dalbar Research analyzing investor behavior patterns, this approach typically means you sell near the bottom and buy back after significant recovery has already occurred. Approach 2 is systematic. You recognize this as a predictable probability event. You maintain your systematic investment plan. You might even increase purchases during the decline because prices are lower. Let's run 30-year numbers. Approach 1, with periodic behavioral interference, might capture approximately 6% annually. 10,000 initial investment plus 500 monthly equals approximately $503,000. Approach 2, maintaining systematic behavior through drawdowns, captures approximately 9% annually. Same contributions equal approximately $907,000. The transformation from reactive behavior to systematic behavior is worth approximately $404,000 over 30 years. That's not a theoretical difference. That's real wealth created by behavioral transformation. Simons built institutional structures that enforce this transformation. According to company information, Renaissance researchers couldn't override models based on feelings. The system executed regardless of whether humans felt confident or terrified. For individual investors, you create this transformation through commitment devices. Here's what I mean. Instead of giving yourself discretion to adjust behavior based on feelings, you create automatic systems that execute regardless of feelings. Example: automatic monthly investments that continue regardless of market conditions. According to research from Fidelity analyzing 401k contribution patterns, investors who maintained automatic contributions through the 2008 financial crisis, when markets declined approximately 37%, captured the entire subsequent recovery and significantly outperformed investors who stopped contributions during the decline. The transformation from intellectual understanding to behavioral execution requires three elements according to behavioral economics research from Daniel Kahneman and Amos Tversky. One is pre-commitment. You decide your systematic behavior before emotional situations arise, not during them. Two is automation. You remove discretionary decision points where feelings can interfere with mathematics. Three is environmental design. You structure your information environment to reinforce probability thinking rather than prediction thinking. Let me give you a specific example of environmental design. According to research from behavioral finance studying media consumption patterns, investors who check portfolio values daily experience approximately 2.5 times more emotional volatility than investors who check quarterly. This emotional volatility typically increases behavioral interference and reduces long-term returns by approximately 1 to 2 percentage points annually. The transformation isn't about getting smarter. It's about structuring behavior so that mathematics has room to work despite human emotional limitations. Simons didn't succeed because he had superior emotional control. He succeeded because he built systems that made emotional control irrelevant. For regular investors, you can't completely remove emotions, but you can structure decisions so emotions have fewer opportunities to interfere with mathematical expectation. Here's the insight that completes the framework. Time transforms probability from theoretical to reliable. This might be the most important concept in this entire analysis. Simon's 39% average annual returns sound extraordinary, and they are. But here's what people miss. Those returns required 30 years to achieve as an average. In any single year, according to available performance data, returns varied dramatically. Some years delivered 70% gains. Other years delivered 15% gains. Some years lost money. The mathematics worked over time, not in time. That distinction is crucial. Let me demonstrate with numbers why time horizon fundamentally changes probability outcomes. According to Dimensional Fund Advisors research analyzing rolling return periods in U.S. stock markets from 1926 through 2023, one-year periods were approximately 73% positive, meaning 27% negative with high variability. 5-year rolling periods were approximately 88% positive with lower variability. 10-year rolling periods were approximately 94% positive with much lower variability. 20-year rolling periods were approximately 100% positive, essentially eliminating negative outcome probability. Watch what's happening mathematically as time extends. Probability distributions stabilize. The same underlying assets, the same probability expectations, but dramatically different outcome reliability, simply because time allows probability to overcome randomness. Here's the calculation that transforms thinking. Suppose you invest $10,000 with expected annual return of 9% based on historical probability distributions. After 1 year, your most likely outcome is around $10,900, but you could reasonably be anywhere from $8,000 to $12,000 based on normal market volatility. After 20 years, your most likely outcome is approximately $56,000, and the range of reasonable outcomes narrows significantly. Time has allowed probability to dominate randomness. This is why Simons could build a strategy around tiny probability edges. With sufficient time and sufficient repetitions, small probability advantages become reliable outcomes. It's not magic, it's mathematics. For individual investors, this insight changes everything about financial planning. The question isn't what will markets do next year. The question is, what probability distribution am I working with, and do I have sufficient time for that probability to overcome short-term randomness? Let me show you a specific example that demonstrates this principle. According to Federal Reserve data analyzing wealth accumulation patterns, households that maintained consistent investment behavior over 30-year periods typically accumulated approximately 8 to 12 times their total contributions based on average market returns. Households that attempted to time entries and exits based on predictions typically accumulated approximately 4 to 6 times contributions. The difference isn't analytical sophistication. It's time combined with systematic behavior that allows probability to work. Here's another calculation using real numbers. Two investors, both contributing $500 monthly for 30 years. Investor A maintains systematic behavior, capturing approximately 9% average annual return. Result: approximately $907,000. Investor B attempts to improve outcomes through timing, periodically stopping contributions or switching strategies based on predictions. According to Dalbar Research, this typically reduces average annual return to approximately 6%. Result: approximately $503,000. The $404,000 difference came from one investor giving probability sufficient time to work systematically, while the other disrupted probability through behavioral interference. Simons understood that his advantage wasn't predicting better than others. His advantage was having sufficient trading frequency and sufficient time horizon that his probability edges could manifest through sheer repetition. In 30 years, executing thousands of daily trades, his models made millions of probability calculations. Small edges compounded into extraordinary outcomes through time and repetition. You can't match his trading frequency, but you can match his time horizon and systematic approach. According to research from Vanguard analyzing retirement account outcomes, investors who maintained consistent contributions and systematic rebalancing for 35 years had approximately 94% probability of achieving or exceeding their financial goals. Investors who maintained contributions for only 15 years had approximately 67% probability. Time isn't just helpful. Time is the variable that transforms probability from theoretical to reliable. The insight here is transformative. Stop trying to compress financial success into short time horizons. Short time horizons give randomness dominance over probability. Extended time horizons give probability dominance over randomness. That's not opinion. That's statistical mathematics. Interesting social experiment. I want to test whether people who think mathematically about money cluster in certain geographic areas. Drop your city and state in the comments below. I'm genuinely curious if probability-based thinking about finance correlates with specific regions. Phoenix, Austin, Miami, Seattle, Denver, wherever you are. Let's map financial thinking patterns. Comment below. Now, let's synthesize everything into a coherent framework. What did Simons actually prove over 30 years and $28 billion of results? He proved that systematic behavior based on probability distributions reliably outperforms discretionary behavior based on certainty feelings, given sufficient time horizons and behavioral consistency. That's the entire framework distilled to one sentence. Everything else is implementation detail. Let me break down the framework components and show you how they integrate. Component 1 is probability over prediction. According to mathematical principles, you can't reliably predict specific short-term outcomes in complex systems with high randomness. But you can identify probability distributions that favor positive outcomes over extended periods. Simons focused on the latter, not the former. Application for individuals. Stop trying to predict which investments will outperform next year. Start identifying asset classes with favorable long-term probability distributions based on historical data spanning multiple decades. According to research from Dimensional Fund Advisors, diversified equity portfolios had positive returns in approximately 94% of 20-year rolling periods since 1926. Component 2 is systematic behavior over emotional reaction. According to behavioral finance research from Kahneman, Tversky, and others, human emotions spike during extremes and trigger counterproductive behaviors. Fear maximizes at bottoms. Greed maximizes at tops. Both emotions generate horrible timing signals. Simons eliminated emotional interference through systematic execution. Models traded regardless of feelings. Application for individuals. Create commitment devices that maintain systematic behavior during emotional extremes. Automatic investments that continue during market declines. Rebalancing schedules that execute regardless of whether you feel confident or terrified. According to Fidelity Research analyzing 401k behavior, automated contribution plans outperformed discretionary contribution plans by approximately 1.3 percentage points annually over 20-year periods. Component 3 is time horizon appropriate to probability. According to statistical mathematics, probability requires sufficient sample size to overcome randomness. In markets, time serves as the sample size variable. Simons understood his probability edges needed millions of trades over decades to manifest reliably. Short time horizons would have shown randomness dominating his small edges. Application for individuals. Match time horizon to probability distribution. If you need money in 2 years, probability distributions for equities are too uncertain despite favorable long-term expectations. If you have 25 years, probability distributions become highly reliable. According to Vanguard Research, equity portfolios had 0 negative 20-year rolling periods since 1926, despite frequent negative 1-year periods. Component 4 is minimize behavioral complexity. According to decision science research, every additional decision point creates opportunity for emotional interference to disrupt systematic behavior. Simons minimized decision points through automation. Models executed without human discretion. Application for individuals. Build financial systems that minimize decision points. Index funds instead of individual stock selection. Automatic rebalancing instead of discretionary timing. Target date funds that adjust automatically instead of requiring manual allocation decisions. According to Morningstar research, investors in target date funds maintained more consistent behavior through market volatility compared to investors making manual allocation decisions. Now here's the synthesis that matters. These 4 components aren't independent. They're interconnected parts of a mathematical framework that works because it aligns human behavior with probability mathematics rather than fighting against human emotional limitations. Let me demonstrate with a complete example. Suppose you're 35 years old planning for retirement at 65. You have 30 years, sufficient time for probability to overcome randomness. Traditional approach: try to predict best investments each year. Switch strategies when performance disappoints. Attempt to time entries and exits based on economic predictions. According to Dalbar Research, this approach typically captures approximately 50 to 60% of available market returns due to behavioral interference. Framework approach inspired by Simons' principles. Identify asset allocation with favorable probability distribution over 30-year horizons. Implement automatic monthly investments. Automatic rebalancing annually. 0 discretionary decisions during emotional periods. According to Vanguard Research, this approach typically captures approximately 90 to 95% of available market returns. Over 30 years with $500 monthly contributions, the difference between capturing 50% versus 90% of market returns is approximately $400,000 based on historical market data. That $400,000 represents the value of aligning behavior with mathematical probability instead of fighting against emotional limitations through willpower. The synthesis is powerful, but simple. Simons didn't win through superior prediction. He won through superior behavioral structure that allowed probability mathematics to work without interference. You don't need quantitative models to apply this framework. You need systematic behavior that minimizes emotional interference with favorable probability distributions over appropriate time horizons. Let's get specific about application. How do you actually implement this framework in regular financial life? I'm going to give you concrete steps backed by research. Step 1. Determine your time horizon. This isn't optional. According to financial planning research from the Certified Financial Planner Board of Standards, mismatched time horizons and investment strategies represent the primary cause of financial plan failure. If you need money in less than 5 years, probability distributions for equity investments are too uncertain. According to historical data, approximately 12% of 5-year periods showed negative returns despite positive long-term expectations. If you have 20-plus years, probability distributions become highly reliable. According to Dimensional Fund Advisors research, 20-year rolling periods showed negative returns in diversified equity portfolios since 1926. Concrete application: create time-bucketed accounts. Short-term needs go in high-certainty vehicles like savings accounts or short-term bonds. Long-term goals go in equity-based investments with favorable long-term probability, but high short-term uncertainty. Step 2. Automate systematic behavior. According to behavioral economics research, automation removes decision points where emotions interfere with mathematics. Concrete application: set up automatic monthly investments on a fixed schedule. According to Fidelity Research analyzing millions of 401k accounts, automated contribution schedules maintained 97% consistency during market downturns, while manual contributions dropped approximately 43% during the same periods. Result of automation: you're buying more shares when prices are low, fewer when prices are high, which improves long-term mathematical outcomes without requiring any prediction skill. Let me show you the mathematics. Suppose markets decline 20%, and you're automatically investing $500 monthly. Before the decline, $500 bought 10 shares at $50 each. After the decline, $500 buys 12.5 shares at $40 each. When markets recover to $50, those additional shares you purchased during the decline are now worth 25% more than you paid. This is mathematical arbitrage of behavioral patterns, not prediction. Step 3. Design your information environment. According to research from behavioral finance studying media consumption, information frequency dramatically impacts behavioral consistency. Investors who check portfolios daily experience approximately 2.5 times more emotional volatility and make approximately 30% more behavioral adjustments than investors who check quarterly. Those behavioral adjustments typically reduce returns by 1 to 2 percentage points annually, according to Vanguard Research. Concrete application: limit portfolio checking to quarterly reviews. Unfollow financial news accounts that create emotional urgency. According to research from Duke University analyzing news consumption and investment behavior, investors who consumed high volumes of financial news made approximately 40% more trades, and underperformed investors with low news consumption by approximately 1.8 percentage points annually. Step 4. Build decision firewalls. This means creating rules that prevent emotional decisions during market extremes. According to behavioral economics research, pre-commitment devices that remove discretion during emotional periods significantly improve long-term outcomes. Concrete application: write down your investment plan during calm periods. Include specific rules like, I will not sell during market declines of less than 30%, or I will maintain automatic contributions regardless of news headlines, or I will rebalance only on predetermined annual dates. According to research from Financial Planning Association, investors with written plans